Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hello, everybody. Welcome to another episode of Vantage Point with True North Wealth Partners. Today is Tuesday, April 21st of 2026, episode number 51. So welcome. Unfortunately, Andy is out sick today. Eric and the crew, they're all tied up. So I'm holding another episode by myself, but hopefully you'll learn a lot, and we'll recap what has transpired first quarter, year to date, and what we see going forward. So strap in, a lot of information, tons of visuals. Hopefully you can retain a lot of this information. And as I get into this, I still have to read my disclosure for Stratus and the compliance. So any information I hold up or what have you, it's information obtained by third-party source, which are believed to be accurate, but cannot be guaranteed for its accuracy or completeness. When I ask about asset classes or products diversification, the following information is in general information purposes only. It is not intended to be specific investment advice. It's important to consult your financial advisor who understands your individual financial situation prior to making any investment decision. And lastly, when I talk about like my beliefs, or if I mention anything, it's my opinion, it's we believe, what have you, it's Eric Susi, it's me, it's not Stratus or anybody else. So it's anything I say is all coming from me, the horse's mouth. All right, so what a ride it's been. Woo! There you go, up and down, bull market, bear market. What are we doing? So, a little volatility. Like I said back in January, strap in. I do anticipate this year to be volatile, just like last year. So we'll, get into it a little bit here. So in regards to like the markets and where are we, obviously didn't anticipate, the Iran, hitting that so fast. That obviously put the markets down for a month. The low was interesting. How the market low is on March, so far year to date, March 30th. So with this being said, this is here from Charles Biello. So he puts together this nice little chart. Nathan, our producer, will pound into this, but check this out. It's pretty neat. So again, it took 61 days to have a 9.8% decline in the S&P. Okay, the high was, 7,002. 7,002. But that's, so March 30th was the low so far year to date. So remember, corrections minus 5%. A pullback is minus 5%. A corrections minus 10%. The bear market and recessions, bear market's 15, recessions 20, et cetera. So with that said, there are many asset classes, Dow, NASDAQ, others that were well over 10% declines. So that was correction territory. So the S&P being down only 9.8%, okay, 0.2 away from 10%, I'm calling that a correction. So we're close enough. But I did at least want to, mention that to you, that we basically had a correction. So, and again, called for with the markets and the quads and the shifts that are going on. Speaking of shifts, let's go through that. Hedgeye, we use Hedgeye. For the great research team and analysis, still on the SIM, Stratus Investment Management, their committee, and they do great work in putting together their analysis. So Hedgeye, I'll just hold this up as well. This is pretty neat. They come up with a weekly summary. So this is last week's weekly summary through Friday, April 17th. So remember the chop bucket. I'm going to start with that. So the chop bucket, it's the investable bucket. If it's below 19, the chop is between 20 and 29. That's what we've been in for basically the past month. Has been to the VIX. The VIX gauge has been in the chop bucket between 20 and 29. The F bucket, you know what that means. Anything above 30, nobody makes money. It's all about losing less. So we hit that briefly a couple times over the past month. But most of the past month plus has been in the chop bucket, meaning the VIX, the volatility index, has been between 20 and 29. Currently, we're back on Friday there where it ended, and Monday is right around 18, 17, 18, et cetera. So I always like to just go through that. The quads, as you see, the monthly quads, we're in a quad 2 right now. That just means growth is increasing, inflation's increasing. So that's the transition from a quad 3 to a quad 2. That's what has happened. That's why you had the market bounce back over the past 2 weeks. That's a transition. The quarterly, that's the monthly quad 2 in for the month of April. Quarterly is second quarter, we're in a quad 3. That means growth is declining overall in the second quarter and inflation's increasing, and it has been. And obviously you hear the word stagflation. And then global, the global markets are in a quad 3 as well. So monthly, quarterly US and global, that's where we're at. A nice little pocket as well that Nathan will check that out. This is hard to zoom in on, but you'll see the monthly quads. Again, April, we circled there the quad 2. Okay, that's what we're transitioned from a quad 3 to a quad 2. That's what has occurred. If you look out, there's ones, twos, a couple threes. So I will point out in November of this year, the percentage projection that would be in a quad 4, that was earlier revisions, used to be a quad 4 in November of this year. That's now off the chart. I do not see any reds. So there's no reds, just quads 1s, 2, and a couple 3s. So that's how fast and information changes. A data input gets updated, then the nowcast gets updated as well as far as the CPI, GDP, the monthly quads, et cetera, and quarterly quads. So always like to just give you that update as well. And then one last summary, again, with Hedge Eye's quarterly quads, or just the quads in general, excuse me. Quads 1 is just a recap to remind you, growth's increasing, inflation's decreasing. Quad 2 is growth increasing, inflation increasing. That's what we're in for the monthly of April, is a quad 2. Quarterly, second quarter, we're in a quad 3 overall, which is quad 3. Growth is declining and slowing, which it is, and inflation is increasing, which it is, primarily due to the Iran war. And in quad 4, batten down the hatches, everybody loses. It's about losing less. Growth going down and inflation going down. That's just the overall quad environment. So I'd like to just recap that with you. And then obviously, we had a nice little bounce there in regards to the markets past 2 weeks. That was the fastest rebound and since like the 1992, I believe, if I can recall correctly. So it's incredible, bounce. So you can see how the markets move back and forth and snapping the string. So S&P, last Friday, it closed above 7,100 in the S&P. That was the longest win streak that we've had since 1992. Like I mentioned, 12 out of 14 days, the S&P was up. And then NASDAQ, it just snapped as of yesterday. It snapped a 13-day winning streak for the NASDAQ as well. So just wanted to point that out as far as some information. Now going into the nowcast for April is inflation. So the April inflation, you can see this. And as a reminder, Kevin Warsh was on on Congress, getting testified today on the Hill. Did an excellent job, and he was talking about how he's going to restructure the Fed and the policies and how it's all archaic and backward looking. Kevin Warsh and Scott Bessent, the Treasury Secretary, both use Hedge Eye. They've been using them for longer than I have. I've been using them for over 10 years. They're doing 15 plus years. So they get this information. So the Trump cabinet, they get all this. This is great. This is the most accurate forecast. So they realize that it's been broken. The Fed, and they're always late to the dollar, late to everything, looking in the rearview mirror. So inflation coming out on May 12th for April. Inflation is projected to be 3.62%, coming off an extremely high print of 3.26, which came off a lower print of 2.41. That jump 1 month was due to the war, and obviously it's going to continue onward. So sneak peek, we might hit, I said earlier in the Q1 on my video podcast for the first quarter in January, I said, hey, you're probably going to see a 3 print for the CPI. Well, we're going to see a 4 print. So a 4 handle I did see for the fourth quarter. So you might see a 4% inflationary handle possibility later by the end of the year, but not like 8 or 9 like it used to be under the prior administration. But this too will pass. It's temporary. So he knows he's got to wrap things up in order to keep the economy from going into recession, which we still don't see, just market volatility, and also for midterms as well. GDP, this just came out today from Atlanta GDP, release date today, 21st. First quarter GDP, they're now cast, and there is a 1.2%. So it's 1.2% is what they anticipate the GDP growth rate for the first quarter of 2026. Again, you want to be above 0, obviously. Roughly it's been north of 2%. So if we can be around that 2%, It's 1.2 right now. So it's declining. That's what we saw. That's why we're in a quad 3 for the second quarter. Is growth is slowing, inflation's up. That's the environment we're in. That's hence why you get the quad 3. All right. And then earnings. So earnings, they've come out stronger than anticipated. So so far, this came out by FactSet. This is April 20th when this was published. So FactSet, which excludes the Mag 7 companies, expected to report lower earnings than the other 493 companies that are out there in the S&P 500. This is pretty neat. So again, on this chart here, Nathan will blow up in. So first quarter earnings so far, you can see the Magnificent 7 for the Q1 2026 is 22.8%. Great. The other 493 is 10.1. Okay. But then if you were to exclude NVIDIA, I'm on the bottom chart there. If you exclude NVIDIA in the blue, so you take the Magnificent 7 minus NVIDIA, it drops down to 6.4% earnings growth rather than the 10.1. So that is dramatic. So that just speaks to, that's why we have gotten more broadening of, I mentioned this end of last year, November, December, and into this year, the broadening of the asset class and markets are working finally. So you're not putting all your eggs in one basket, i.e., 12 or so companies making up 40% of the S&P. So that's got to change. So that's good that you're seeing a broadening of the performance here. And then as well, again, of the Magnificent 7 for the calendar year. That was a Q1. And calendar year 2026, again, Magnificent 7's 24.6%. What the earnings are. The other 493 so far is 15.9%. That's projected there as earnings growth rate. But then if you subtract out NVIDIA for the whole calendar year, again, of 2026, then it's be down to 13.2. So the point is this. Let's focus in on the S&P, okay, the other 493. That's 15.9. At the beginning of the year, Sim and other research folks were hoping to get earnings growth rate north double digit, 12 to 15%. Great. So that's what's projected. I was hoping for 10% plus. So fingers crossed, we're still north of that. So that's good. Earnings look good is what I'm trying to say. So that's important overall when it comes to first quarter. Again, the first quarter is come and gone. We're in the second quarter. So that's why you have to be forward guidance and what's ahead of us. So we're not out of the woods at all, but, just ebb and flow. That's the market's ebb and flow back and forth. With that said, let's get into tips of the month, if you don't mind. So tips of the month, a lot of great charts here. Nathan will post it on this. This is the S&P 500, okay? So the 500 companies, this is all distributed on a visual chart, okay? A Visual Capitalist pushed this out data as of March 30th, 2026. So the S&P 500, what's interesting is 13 companies make up over 40% of the S&P 500 market cap. 13 companies make up over 40% of the S&P 500's market cap. And they are, not in particular order, but NVIDIA, Microsoft, Apple, Broadcom, Amazon, Tesla, Alphabet, Class A and C, and then Meta, Walmart, Berkshire, JP Morgan, and Lilly. So those 13 companies, again, out of the 500 companies in the S&P, make up 40% of the S&P. So that's what I was just talking about earlier, how, we need a broadening of the stock market. It used to be Magnificent 7 only. Now here, the top 13 make up 40%. So we want this to broaden out. That would be very helpful in the overall economy and for the markets in general. This is why active fund managers are having a great year versus passive and indexes, because there's a lot going on underneath the surface. Data centers. So speaking to Nathan, our producer, I held this up over a year ago. Columbus broke the chart, like 49 on the top 50 or so for the U.S. data centers. So this chart just got released as of March 2026, again from Visual Capitalist. So Ohio jumped all the way from the bottom of the chart to number 6, 250 data centers. Okay, 101 are operational, 51 is under construction, and 98 are announced. So that is a tie with Illinois. And Arizona, it ranked 5th as 254, so 4 more than us. So it's amazing how fast We've seen this all around anyways about the data centers in Greater Columbus. You drive around the belt and it's crazy. So there you are. We're IT tech hub now trying to, they're doing that because there's no, our weather climate is stable. There's no hurricanes per se, no necessarily shifts or what's that called? Earthquakes per se. Ample water source, cost of living is reasonable, and you got 4 seasons. So that's why Ohio is turning around and looking much better. This is pretty cool too. Natural gas production. Okay, this has got released again from Visual Capitalist. So this is as of March 2026. So U.S. number one is as far as the production of U.S. natural gas. Number 2 is Russia. Number 3 is Iran. So that surprised me to see Iran up there. So U.S. Then number 4 is China. Number 5 is Canada. So those are the top 5. So U.S. output roughly tripled since 2005 as hydraulic fracturing unlocked the shale formulations that were previously uneconomical to drill and extract. So by doing the shale and vertical and horizontal natural gas extraction is why we're now the leader in the natural gas. We're shipping it across as well. So oil, we're number 1 in oil volume, and then now natural gas as well. This is pretty cool. Another chart here, the largest SpaceX IPO, it's coming out here, okay, versus other large companies. Watch this. So later this summer, when SpaceX goes IPO, they're going to be valued at $1.75 trillion. Okay, so let's see, what is that? 1, 2, 3, 4, 5, 6, 7, 8. 8th largest company in the, I guess, country, World Stock Exchange, what have you, in history. It's amazing. So, this is big time. And what's going on up there, too? I've been on a lot of calls and stuff. So, Elon, what he wants to do is put data centers up in space. That's what this is all about. So, data centers up in space because it's cool. And then you have the energy from the sun right there. And so, it's all about the shields on the satellites. And on their wings there, they have these different chips that are laying there, extracting the energy and producing it out. So that's what's going on. So that's a whole nother tier. And in addition to that is the robots. So robots will be bigger than cars. And then the satellites up there, the data center. So that's what's happening. So just to give a little peel back, again, this is all 3D chess, what's coming down the road. So just thought you'd be interested in that. But on many calls about that. All right, last, you've heard me talk about commercial valuation. It hasn't been a mark-to-market since 2008, okay? So, great. This is the KeyBank building in Columbus. I was talked about Columbus valuations and how buildings are not sized correctly as far as getting, they're overestimated as far as evaluations. And so, as an example, the KeyBank building, okay, let's see, under the letter, bear with me here. Trying to find the dollar amounts. But anyways, on the auction, okay, last Tuesday. Okay, this is come from Business First, okay, where all this came from. And so basically, April 16th is the date of this. The building, which came out on auction last Tuesday for a minimum bid of $1 million, it closed and basically it sold at auction for $5.1 million. Hello. That big building for only $5.1 million. That's crazy. What I'm trying to say is over the years, like Schockenstein proprietary, they talk about here, they bought it for $12 million back in 2022. It just sold for $5.1 million. So at the time, the Franklin County Auditor's website valued it at 8.96. Let's call it $9 million in 2025. So this is what I'm talking about, taxes and valuations. So commercial buildings are up here. Auditors are pricing it for here. But when you do a true mark-to-market, when you sell a commercial real estate, it's not going for what it is. So what's going to happen? You have less tax revenue heading into the city of Columbus coffers. So strap in. There's going to be a lot of states and cities going through issues with their overall tax receipts. Won't be as grand as they thought as these commercial buildings get properly resized and marked to market. So just interesting times. I've been talking about this for years, but I did want to at least, there's a recent proof of what I've been talking about. All right, let's get into charts. We'll end on charts here, folks. Stay with me. A lot of great visuals here. Stock market pullbacks. Okay. Well, not even that. Let's talk about all-time highs first. So all-time highs, we've had 7 this year, 7 all-time highs. The latest just occurred on Friday. That was on April the 17th when the S&P notched over 7,100. That was an all-time high. So that was the last time we've had an all-time high, 7 so far year to date. You can see over the years how we've done. The VIX, the volatility index, okay, right now it's at 18.9. The average is 18.4. Well, a couple of weeks back, like 3 weeks ago, we had a VIX well over 30. Okay, so about 35 actually. So you can see how the volatility index moves up and down. And so right now it's calmed back down somewhat, but the volatility is something, it's a canary in the coal mine that we look at. The PE ratio for the S&P, it was north of 24. Right around 24. Right now it's at 20.1. So it's come back down. That's good. The historical average is 15.9, but it's good to take a little fluff, let some air off out of the stock markets. You don't want to be vertical forever. And the 5% pullbacks, like I talked about, we had 1 so far year to date. We'll see more 5% pullbacks will be occurring, like I mentioned earlier in Q1. On the podcast. 10% pullbacks technically didn't register. So that's where, on this chart, you'll see a blank there. We had 2 10% pullbacks last year. I am going to go with 9.8, technically hit 10%. So I'm saying 1. Okay, it's just me, Eric Susi, talking here. But we did have 1 10% pullback based on Eric. Bond market volatility, okay, it's called the MOVE index. It was real calm. It was eerie calm. Okay, basically in that 60 range for weeks and weeks, and then it spiked up. It started going higher. It shot up there to about 140 or so, and then it came back down. Where currently it's back to 68. Historical average is 86. Again, this bond markets move before the stock markets. Learn this at T. Rowe Price in the trading pits, and I follow that as a canary in the coal mine as well. S&P earnings growth rate still looking strong, 15.3. Okay, that's trailing 12 months. Again, quarter over quarter, I talked to you about the 1.2% GDP nowcast from the Federal Reserve Atlanta for the Q1 of 2026. Well, fourth quarter was revised downward to 0.5. Okay, so it's still positive, but you can see the slower growth. That's why we're in a quad 3 overall for the second quarter of 2026. Sector returns year to date. You can see energy, the peak return was about 40% at some point this year. And right now we're at almost 23%. So you can see, look at the little blue diamonds, the peak materials was a little, closer to 18, and now it's at 14.6. Industrials, again, north like 14, 15-ish. Now it's at 12.1. What's the laggards or financials down 4 and healthcare down 4.9. And it's a neat to see a sector rotation and how things move. Asset class performance, again, commodities 2026. That's why you still own commodities and a lot of the funds that we have, up 22.6%. This is latest data through April 20th. So commodities is leading the charge, emerging market second, small cap third, EFA's international, then balanced funds in the middle, S&P, and then fixed income. That's just general broad asset classes. Bitcoin. So Bitcoin is on the left axis, dollar's on the right axis. The dollar, as you can see, it was much higher in the 2025, 2024, in that range, 2025. Let's call it 109, 110. Then the dollar went down, weaker dollar, okay. And then it started to go up a little bit stronger, and then it turned around. And right now the dollar is basically 98.1. So that's the dollar. Okay. Bitcoin's on the left axis, as you can see. It's right now 76,316. Okay. Now look at the Bitcoin there. You can see on the left axis, back in January 2025, it was like 125,000 almost in that range. So you can see Bitcoin that ran up. That was the high point, came back down. But the upshot, when the dollar goes weaker, then Bitcoin takes off, and vice versa. When they have a strong dollar, typically Bitcoin goes down. That's the inverse relationship of how those two work typically. Gold in the stock market, again, you've had gold for over 3 years, and silver, which we sold off some last year. Take the profits. As you can see, the gold, year to date, going back there, it's not year to date, but going from 2010 10 through now, okay, through April 20th, 2026. Gold's up 552% versus the S&P is up 548. So gold is beating the S&P. So that's a pretty cool chart, especially the past few years. That's why we took profits, trimmed a little bit off. Oil, U.S. oil production. I want to show the millions of production of barrels per day. So the average was 8 million. Right now, we're currently doing 13.2 million barrels per day. So that's the the most that we've been doing. So that's why we're exporting some to foreign countries, abroad, et cetera. CPI, Consumer Price Index, okay, 3.3. Core is 2.6. Core excludes food and energy. Okay, so that's why we track that. That's what the Fed likes to use. And really that they focus in on is the PCE. The PCE, again, their goal was to get it down to 2% on the PCE. On the core PCE is 2. Right now it's showing 3% for the core PCE. So 1 percentage point higher than what the Fed mandate would like to be. So hopefully Kevin Warsh gets in there and does things differently, let's put it that way, than Powell. Weekly jobless claims, this is pretty interesting too. It's been steady. Job market in general, there's still, the last is $207,000. 4-week average is 210,000 jobs. But the 4-week, you can just sort of see how the pandemic, it grew, and then it's back to, in that range. It's called around 200,000 plus or so. So that's just the weekly jobless claims. Job openings and the quit. Again, the two mandates are inflation and jobs. So that's why the focus on this. That's why I'm talking about it more now. JOLTS is a job opening report. That's about 6.9 million jobs. Still plenty of jobs that are out there. The average job openings is 5.5. Right now it's 6.6. And the quits, these are the people who want to quit one job for another. Okay, there was stronger and higher earlier on, but now it's back to 3 million quits versus over 4 million quits. The average is 2.8 million quits. So it's right around the average. So people are, so jobs are just hanging in there. And then the yield curve, the 2-year, 10-year, the spread for over 2 years was negative, below zero, as you can see that. And they never call it a recession, quote unquote. Parts of the economy were in a recession, but not all. But the point is this. Right now, it's 0.54 is the spread between the 2 and 10 years. It's the invertedness of, it's the steepness of the yield curve between the 2-year and 10-year, the yield. The average is 0.84. Right now, it's 0.54. And then lastly, we'll end on is mortgage rates. So it's been tough out there. Like I said in the first quarter of the VOD podcast, you need to see 5% print. We're at 6.3. We're not in that low 5s, upper 4s. So we'll see. It's going to be another tough year. We're in late spring and heading into summer now. So, it's going to be a tough year on the housing market. So just wanted to, keep things real, show a visual of all the information going out there. So that was a ton of information. We do appreciate you. Follow along as best you can. Again, you can watch, pause, rewatch it. Reach out to us if you have any questions. If you want to do a review, call, webinar. I know we have clients in 26 states. So, for those clients who phone review, webinar review, et cetera. So that's no problem. We're here for you. Eric and the crew, Andy and Russ, and Stacy, of course, the glue of the office. We all say enjoy spring with your family. Can't believe it. School's almost out, another month. And my daughter, my oldest, is heading off to college. Can't believe it. So Ella's 18, just turned 18, about a week ago, and they're heading to Miami University in Oxford, Ohio. So proud of her. Way to go, Ella. And we'll see you all next time. Appreciate you. Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. Opinions expressed in this podcast are for general information only and are not intended to be specific investment advice. It is important to consult a financial advisor who understands your individual financial situation prior to making any investment decisions. Some of the information contained herein has been obtained from third-party sources which are believed to be accurate, but we cannot guarantee its accuracy or completeness. The information should not be regarded as a complete analysis of the subjects discussed.